Hello, and welcome to this latest Renegade Investor Report with me, Graham Rowan. And today we're going to look at the subject of how the rich use real estate. Now, spoiler alert, the report is brought to you by Property Connections and by Monaco Estate, both of which are actually going to feature at some point in this broadcast. So I won't say any more about them just yet, but the whole topic of real estate is one that's fascinated investors, I think, for many years. And it's clear that it continues to be a cornerstone of wealth creation and of wealth protection. So what I want to do today is try and really focus more on how the wealthy have bent the asset class of property to their means and their will, with some particular strategies that I want to share with you that I think you might find illuminating. And what I hope we can avoid is any kind of politics of envy, if you like. Yes, we're talking about people who, in some cases, who are very, very wealthy, but there's always something we can learn from what these people do, how they operate. They get some of the best advice available on the planet. So, they kind of know what they're doing. So before you just dismiss it out of hand, or you think, oh, that doesn't affect me, or, I don't like the fact they're so wealthy, at least keep an open mind, see what you can learn from this, and see whether it could impact your investment strategy with regard to real estate going forward. And of course, I think one of the great inventions of the last 100 years has been the game of Monopoly. And if you get bored over Christmas, why not pull out the old Monopoly set and have a game? Because it's one of the best financial education tools out there. If you're at a slightly more sophisticated level, you might have Robert Kiyosaki's cash flow game, which takes it a little stage further. But whichever, the game of Monopoly has been a really powerful influence on many investors. And I'm actually going to use that as part of my structure for how we're going to cover this broadcast, because the game itself actually gives you different strategies. And obviously it's based on a point in time when property prices were rather more modest than they are today. So it can seem a little bit unrealistic when you see what they put as a price on Old Kent Road or Mayfair or Park Lane, but the principles are all there. And different people have followed different investing strategies, very much based on what you learn in the Monopoly board game. So the only thing I think is kind of amusing as we enter the 2020s is that they've had to introduce a Monopoly Express version for people's withering attention spans. Some of these games can take hours and hours, and of course that doesn't work these days. Everything's got to be instant gratification. So there's an express version of Monopoly out there if you find it all too much. And I'm grateful to Rentify for this table I found. This was, I think, done around 2014, 2015, but it's just trying to bring Monopoly up to date with the right-hand column being the prices on the original board game, and the left-hand column being the average rent per calendar month in each of those streets in the mid-2010s. So you can see that whereas in Monopoly you could buy the whole of Whitechapel Road for £60. A single property there would now cost you $1,800 a month or something to rent. It's probably gone up quite a lot more even since then. So, so this is kind of the structure of the game, with different streets having different prices depending on the postcode and the area, but also obviously different investment approaches and different investment strategies being linked to each of those. So let's have a look at what you might call the lower end of the market, what I've called the Old Kent Road strategy. And this is buying lots of cheap houses and cheap flats and accumulating a large portfolio in unit terms. And a great example of this would be the footballer Robbie Fowler. Obviously, my in-depth knowledge of the beautiful game is limitless. I had to check that it was actually Liverpool he used to play for, I believe. And I'm told by people who live around there that there are entire streets referred to as Robbie Fowler streets. And he was earning hundreds of thousands a week or certainly a month, and he started saving some of that, much to the surprise of many, because most footballers are bankrupt within a few years of retiring from the game because they never get any financial education. But he was introduced to some financial advisors by his first manager, and even from when he was a teenager, he started saving and investing, and he went for low-end, low-price properties in and around Liverpool, where he was playing and therefore where he lived. And so he accumulated this big portfolio and has eventually got to a point where he is now what you would call an ultra high net worth individual with a net worth above £30 million, based primarily on parlaying his earnings from football into low cost, low end brick and mortar properties. And of course, what you tend to get with these kind of properties is a relatively low amount of capital growth, but a relatively high yield, rental income for the amount you spend on them. And I can remember, gosh, back in the 70s and 80s, when you could buy terraced houses in northeast England for a few £1,000s, and obviously they've gone up enormously since then. So anyone that was in the property investment game back in the 70s and 80s has obviously seen enormous capital gains because of everything that's happened with the interest rates and the money supply since then. But for this strategy, the Old Kent Road strategy clearly is one of buying in bulk. And some of the high net worth individuals do this now. Even some of the financial institutions have announced they're going to be buying thousands and thousands of properties to play this game and get the highest possible yields out of that. And of course, one of the reasons that banks and high net worth individuals are attracted to this market is the terrible returns on either cash or bonds. They've effectively become non-asset classes because you can't get a return. You can't get anything in a savings account, and a lot of government bonds, although they may be regarded as safe, they're effectively negative in terms of the returns they produce. That forces people to do something else. For many, that's going into the stock market and taking a different set of risks there. But for others, and certainly for a lot of Brits and a lot of Americans, real estate has been the kind of number one default investment class of choice. And Robbie is a great example of that, but that's been reflected really all the way across the spectrum. There are lots of specialist funds that have been set up to buy portfolios in bulk. So if he wanted to sell his 80 homes, there'd be a portfolio waiting to buy it. It could be a real estate investment trust. It could be just a syndicate of private investors. It could even be a Lloyd's Bank or somebody like that who are, I suspect, going to start overpaying. If they want to own 10,000 properties in the next few years, they're going to start paying over the odds for them. And I suspect it'll end in tears, but don't tell them because you might want to sell to them at a nice price. So one strategy that the wealthy are using is the Old Kent Road strategy. Lots of low-cost properties, limited capital growth, usually quite a high yield, and obviously usually held within a company structure these days after the vendetta against the smaller private landlords that started with that nice Mr. Osborne and has continued pretty much ever since with all of these so-called Tory chancellors who seem to think somehow that one of their core constituents, the private landlords, are criminals doing some terrible jobs in society. Funnily enough, there's been a shortage of rental property in some areas with so many buy-to-let landlords getting out the market because of all the new taxes and all the new regulations and all the new fees and costs and licenses and HMOs and all the problems around that. So amazing, isn't it? That the government intervenes and they actually make the situation worse. Who'd ever have thought? At the other end of the spectrum is what you might call the Mayfair strategy, where you're actually going for really high-end properties. And these tend to bring with them particularly a higher capital growth, but they tend to have very poor yields because the rent compared to the amount of capital needed to own the property can be very small. And so generally, the larger, the higher value the property, usually, unless you're in a situation where you have very high, for example, short-term lets as holiday rentals and stuff like that, it's harder to get a strong yield on the high-end properties, but you tend to have more competition for them. There are fewer of them, particularly if we really are talking about prime central London. And to give a bit more depth and analysis on this, I want to borrow from somebody who's a real expert on prime central London, a guy who I know well and who has spoken at some of my events. His name is Jeremy McGivern, and he's a kind of a property buyer. If you want a particular kind of property in Knightsbridge or Kensington, you tell him what you're looking for, and he will go and find it from not just what's on the market, but also from a whole load of stuff that never gets onto the market at all. It's a very similar situation to what I do in Monaco. And he has a newsletter, which I think you can subscribe to for free, which has got some great information in it. So I just want to share some things that came from one of his recent newsletters, because he's really got his finger on the pulse of what's going on in this market. And although there's an element of, he would say that, wouldn't he, because this is his core business, to find people homes in prime London, he's not going to denigrate it, you'd have thought. I think there's some pretty transparent insights here that we can all learn from. So let's just have a look at some of the points he's making. And there's one particular one that really caught my eye. I don't know how far back your own knowledge of the property market goes, but there's a whole generation of people who've only ever known boom times in property, with prices going up and up and up and up as interest rates have come down and down and down and down. But there was a time when property didn't really do much. Certainly in the first half of the 20th century, apart from the fact you had 2 world wars and a Great Depression, there was lots of things that were holding down wealth and prices generally. So, if you had money in the post-war period, boy, were there some bargains to be had. Because some places obviously had been bombed out, some places people were desperate for cash and desperate to sell. Everyone probably still had a very negative view of where things were going. Even though we kind of won the war, we also lost the peace. If you look at what happened in Germany and Japan in the 50s and 60s. So there was a time when there were bargains to be had. And it's a time that I doubt will ever come again, certainly not in my lifetime. But what he found recently was an apartment that was sold in South Kensington a couple of years ago, just before the banana syndrome. It only had a 42-year lease left. So that's kind of mid-term. You do see even shorter terms, and there are ways you can renew leases, but it can be a bit torturous. But 42-year lease, sold for £5.5 million just a couple of years ago. It had been in the same family for 72 years, since just after the war in 1947. And as you can see, the punchline is already there. They paid just £6,000 for this property that then went for $5.5 million. And he posits the question, if you'd gone to them in 1947 and said, hey, Mr. and Mrs. Jones, congratulations on your purchase of this apartment. You've just paid £6,000 for it. Could I take out an option to buy it from you in 72 years' time for £5.5 million, please? They'd have called the police. They'd have run away from you. They'd have thought you were a screaming madman. But what they couldn't have known was that just over 20 years later, another screaming madman called Richard Nixon would take the US dollar off the gold standard and create a world of fiat currencies backed by nothing. And then that would mean that they could print as much money as they ever wanted, and they could just keep on until they eventually discovered something called quantitative easing. They discovered something called financial repression, and their bonds and the interest rates kept going down and down and down and down. The money supply went up and up and up and up, and suddenly property was booming. And of course, that's what's happened everywhere. Now, there's no such thing as the property market. Obviously, there are thousands of property markets. Now, my first reaction to this was, well, I'm not surprised because obviously it's prime central London. And then I suddenly thought about my own family background, because I know that back in that post-war period, where I come from up in Whitley Bay in northeast England, you could buy quite a nice interwar 3-bed semi for £300 or £400 at a time like that. Because don't forget, people were making a couple of pounds a week at this time. It's so hard to put your head into this kind of space where the affordability and the earnings and the prices were so much lower than they are today. So if you happen to have had £6,000 in northeast England in 1947, that would probably have bought you 20 properties, each of which today is probably worth between £250,000 and £300,000, which gets you to 5.5 or 6 million. So you could actually argue that Whitley Bay has kept pace with South Kensington since the Second World War. And I think, to me, the big lesson from that is not that, Whitley Bay or South Kensington has been a fantastic investment. It's been that the value and the purchasing power of money has diminished so much in those years, particularly in the last 50 years post-Nixon, that, it's almost like confetti. So you just need lots and lots and lots more of this worthless paper to buy the same amount of bricks and mortar. And yet, so many people feel this wealth effect, as it's called, because their house appears to be worth a lot more than they paid for it. And simply because they've sat there for 30, 40, 50, or 72 years, suddenly it's worth this much bigger number of pounds or dollars. Well, yeah, it is, but mainly because those pounds and dollars are worth so much less than they were in 1947 or 1967 or 1997. That's the problem. So on the other hand, if you are looking to try and preserve purchasing power, you'd have done a whole lot better buying that apartment in South Kensington or the 20 semis in Whitley Bay than you would leaving 6,000 quid in Barclays Bank for 72 years, in which case by now it would probably be worth about 7,000 quid. So wealth preservation is a key use of bricks and mortar for all of us, and the wealthy are no exception in that regard. Now, is this a good time to buy in prime central London? Let's see what Jeremy has to say about that. He says, we're no longer at a time of maximum fear, but the majority are still a bit nervous. That's true. I still get people jumping off the pavement when I walk by. I still get people, I hold out my hand to shake hands and they recoil in horror. You still have to wear masks in some places. So we are still at the edge of this, anxiety. And a lot of people are sitting on huge amounts of cash, despite the fact, this is what I've just been talking about, it's being eroded every day. Whether you believe inflation is 3%, 6%, 12%, cash in the bank is losing substantial amounts of value every month, every quarter, every year. So you don't want it sitting there for too long. Family offices, private equity and hedge fund partners, and I think we could probably call these the smart money if we wanted an abbreviation, have been pouring significant sums into the property market right now. Jeremy says he was speaking to a guy last week, a senior director at one of the large banks, who said he ideally wanted to acquire a property before Christmas because, quotes, bonuses are going to be huge next year, which will fuel prices going up even further. And that's before all the international buyers start coming back to the London market who've been kept away through travel restrictions. So, insiders are buying now at these prices ahead of what they perceive to be significant rises ahead. Some other facts that Jeremy quotes in his newsletter: German investors have ploughed 847 million into City of London property so far this year, and that's the second highest since 2013, and they're calling that a boost for post-Brexit Britain in an article in the Telegraph.
Over the past 6 months, property owned by the over 65s, that'll be me then, has increased in value by £24.2 billion, worth nearly 5,000 for every older homeowner. So my generation's total property wealth now stands at £1.25 trillion, according to the Financial Reporter. So if I'm regarded as the bank of mum and dad, I've had a good banana syndrome and I'm in good shape right now. Overall, across England, house prices grew by 9.8% in the year to August, up from 7.5% in the year to July. The Northeast, Whitley Bay again, was the fastest growing region with an annual growth of 13.3%. That's probably because more people have been moving up there, getting more for their money, more outside space, bigger properties, etc. And if you're working from home, why not work somewhere like that rather than being in the crowded Southeast? Now, this is interesting. The lowest annual growth was in London, but this is where averages can be so misleading. So you read that figure of 13.3% in the Northeast, and then you read that it was lowest in London, but then look at the small print. While Kensington was up a mere 9.4%, Hammersmith and Fulham was up 15%, more than the Northeast of England, which was quoted as the biggest region in terms of price rises. But when you start looking at the more micro market level, if you own something in Hammersmith and Fulham, you're up 15% in the last year. So, if you had a £5 million property, that's a pretty chunky amount of extra capital gain you're sitting on there. What's that going to be? £750,000 or something? Even Westminster was up 2.5%. That's probably there's probably a negative premium for being that close to politicians. So this is from the Office for National Statistics. This is not him, trying to gild the lily to make you want to buy something. So parts of London have actually seen some of the biggest increases in the last 12 months in the whole country. And London was voted the second best city in Europe to invest in after Berlin in a PricewaterhouseCoopers survey of 850 property investors, lenders, developers, fund managers, and advisors. So people who are involved in these transactions every day are telling their clients, or being told by their clients one way or the other, that London is a great place to invest. So interesting bit of third-party confirmation there. This is what Jeremy concludes. The mistake many buyers are making is they think it's still a buyer's market. And meanwhile, sellers are not putting their properties up for sale because they're so confident prices will be higher next year than they are this year, mainly due partly perhaps to those banker bonuses, and also because more international buyers who are their prime customers will start coming back to London next year. So what you've got is a diminishing supply of really good homes ahead of what's probably going to be a surge in prices, a surge in demand as the international buyers come back. And a great point he makes here, the great irony of a buyer's market is that there are very few buyers, because people are afraid to buy in a buyer's market. That's why it's a buyer's market. So it's back to the old Warren Buffett quote, about being greedy when others are fearful. So the point is, you've missed the buyer's market. You certainly missed the best part of it. And he's saying those are still looking backwards and hoping to achieve those prices again, or think prices have increased too quickly and will fall back again, will be disappointed. I see the same thing in the crypto world where people say $65,000 Bitcoin. I remember when it was $5,000. I'm going to wait for the pullback before I buy. Well, hey, it may happen, guys. But, if you think it's coming all the way back to $5,000, I think you're smoking something. And Jeremy's saying the same about prime central London property. And I think that's a really important point. You've got to really have the cojones to be one of the few buyers in a buyer's market, because a buyer's market is when it all seems like the world's collapsing around your ears. So that's the lesson from him. But of course, one of the big questions is, we're in this period of very low interest rates. We've suddenly got very high inflation. Surely we're going to see interest rate rises. How is that going to impact the property market? And he says mortgage repayments, especially in prime central London, are a very small percentage of people's income. If you borrowed £1.5 million at today's most favorable interest rates, you're only going to be paying less than £9,000 a year in interest. And even if that rate increased to 1.5%, and then the mortgage rate increased to 2.5% because of that, you're going to be paying 25,000 a year. But if you'd borrowed £1 million in the first place, you'd have to be earning at least 200,000 a year. So a payment of 25,000 hardly feels like it's going to stretch you, does it? It's only just over 10% of your income. And that's to support a £1 million mortgage on an interest-only basis. So he says this is one of those times when you're going to see price rises you won't believe. In general, London prices are still below where they were in 2015, significantly so for international buyers when you take into account the exchange rate, because ever since the Brexit vote in 2016, generally the pound has been weakening against currencies like the dollar and the euro. So, it's been a great time for foreigners to buy British property, British shares, entire British companies. That's why we're seeing so many private equity companies coming in and snapping up what they regard as bargains that we have undervalued and underinvested in. So moving back to our monopoly analogy, one of the things you can do there, of course, as well as buying individual houses, is to buy hotels. And of course, the hotels cost more money, but they generally generate higher income if people land on your square where you own a hotel. Now, this is a different model, really. We talked about the Robbie Fowler Old Kent Road strategy. Here, there's much more kind of wealth concentration because these things are big, they're expensive, they're capital intensive. So you need to put a lot of money into a single asset, although there's often scope to make a lot more from them because you can change the use. Obviously, we've seen loads of commercial to residential alterations in recent years. I wonder now if there's actually some golden opportunities as we redefine what we mean by a high street. There are so many cities and towns now with very down on their luck high streets, and yet what you have is prime real estate in those central locations. If something else can be done with it, some combination of social stuff, technology stuff, living space, and some kind of experiential space, you still need to physically go and get your hair cut, for example, or go to beauty parlors and so on, coffee shops, restaurants, etc. Some kind of new definition of a high street could easily prove to be a very profitable juncture. Now, this building here, this is actually the Sharps Pixley Gold Brokerage in St. James in London. And I filmed a couple of my Sky TV programs from there a couple of years ago. And it's an amazing place. If you haven't been, the ground floor is a real emporium of all things gold and silver. You can buy the obvious stuff like gold coins and gold bars and all those kind of things, but there's also solid gold chess sets. There's desk ornaments in gold. There's all kinds of, some of them mind-blowingly expensive but beautiful things made of precious metals. And then if you go downstairs into the basement, it's a whole collection of private safe deposit boxes. And you can buy your gold on the ground floor and then take it down and put it in your safe deposit box underneath. And one of the things that I always say to people is, if you're going to have a safe deposit box, make sure it's not with a bank, because they can switch those off and deny access just like they can the ATM machines. So if you are going to have one, make sure it's a private one outside the banking system. Sharps Pixley, I think from a few £100 a year, you can gain access to effectively a drawer in this great big filing cabinet, and you put all your precious items in there. And the security has to be seen to be believed. I mean, I was filming down there and I was waving my hands around a bit, as I tend to do. And I touched with my elbow one of the units. Suddenly, all the alarms go off. Kashung, the metal doors shut, and this security guy appears at the door, ready to sort me out. So it's very well secured. So it's a great place to visit, just as a part of your education if you're into precious metals at all. And if you are buying some stuff and want to store it, I've got no relationship with them, but just so you know, they do offer safe deposit boxes. There are many other suppliers available. One of the reasons I mention this is that that building is owned by someone who is implementing the Monopoly Board hotel strategy, and that is Lord Alan Sugar. Now, I remember him from the days of Amstrad. I remember being very proud about my my stereo system with the twin cassette decks. That really was quite something in the 1970s, believe me. Now, Lord Sugar is obviously seen as a very successful British entrepreneur. He's all over The Apprentice. I think that's coming back sometime soon. But actually, he could have been up there with the Jeff Bezos of this world and the Elon Musks of this world. He didn't understand the difference between the value of potential hardware and software. Mind you, nor did IBM really, because they let Bill Gates take the MS-DOS system. But had he understood more about software, he could have been a gazillionaire by now. But he made a lot of money out of PCs and gizmos and bits of kit. But he has parlayed the money he made from business into a significant property empire. And I believe he's now made way more from commercial property than he ever did in business. So that's an example of somebody implementing the hotel strategy. Now, it's a higher risk strategy because, as we've seen from the banana syndrome, curveballs can come along which can completely change the demand for and the use of commercial space. So more recently, the smart money in the commercial world has been in things like warehousing and distribution centers. And I read an article just last week that said Britain is running out of warehouse space because we're all buying online. It all has to be distributed. Some companies are now, I think, was it Currys I saw, offering 30-minute delivery through Uber drivers, not through the Amazon drones that are going to fall out the sky and start decapitating us all soon, but through Uber delivery drivers. And that's quite a sensible idea when you think about it, because these guys are around, they're doing different journeys, they're not that expensive, and people want things now. I've ordered that piece of kit, I want it as soon as possible. So that requires really complex logistics and distribution centers and networks, very large. In the Midlands, you should see the scale of some of the things where they're building up in the Midlands, where land is plentiful, and you've got motorways either side, and then you have more tailored last mile kind of distribution centers. So there's all kinds of commercial property opportunities in that space. But also, I suspect a lot of what we're going to see is going to be change of use from things like offices, shops, retail sector, obviously, as I said before. So this is higher risk, higher reward, very much the province of both high net worth people and pension funds and financial institutions. Another one is the joint venture strategy, where high net worth individuals get together either on their own or in syndicates and small groups with property developers. And typically what happens is each project has a special purpose vehicle company, an SPV, set up for it, and they become shareholders in that SPV, and they share the profits in proportion to their investment. Shameless plug number one today, that's what we do with Property Connections. We've done a number of projects now ranging from, I think, $250,000 up to about 650,000 was the investment from individual investors. And they become 50% owners of the SPV company. The developer does all the work and they split the profits between them. And if you find obviously the right developers, the right projects already with planning permission, you're clear about the project appraisals, you understand the selling prices are reasonable, you've got strategies in place in case the market takes a dip. So for example, you might switch to buy-to-let mortgages and rent them out for a while whilst the market recovers. These are all the sorts of things that have to go into a property joint venture. You've got to have the right shareholder agreement. You've got to make sure that the guy has the right track record, understand that they own the site and who's doing the work, all these kind of things. But this has been for a long time now, a popular trend. People who've got money tied up in their pensions, especially if you're a company director with a SAS pension, you can form a syndicate, perhaps put, if 10 of you put 100,000 in each, you've got £1 million. You can do a joint venture with a property developer that way, and all sorts of tax benefits would then accrue to the gains you make from that project because you're doing it within a tax wrapped vehicle. So joint ventures are another way in which the wealthy are using real estate to create wealth as well as to protect wealth. And sometimes people go into these things with a view of buying to own and keeping it for long-term rental income. Other times it's just get in there, build it, sell it, take the gain, and then rotate the money around into the next project. So that's kind of some of the strategies that are going on in property development joint ventures, where you're effectively forcing added value and capital gain. You might be extending something, you might be building another layer on the roof, you might be building out the back, you might be converting one big place into two smaller ones, you might be converting retail into residential, all those kind of things where a change of use, increasing the size of the building adds value to it, and then you're achieving and realizing that either as a gain or as an ongoing rental income and an asset throwing off some cash. Something that's not on the Monopoly board, but is, I think, taking this to another level, is what I'm calling the Monaco strategy, because this is really where we get into what the ultra high net worths are doing with real estate. And of course, with somewhere like Monaco, you've got high and growing demand. You've got a very small place. Now, they're just in the middle of claiming a little bit more back from the Med, which they've actually been doing since 1880. But there's not a lot there. It's about 2 square kilometers, so it ain't a big place. I think it's about the size of Central Park in New York. And back in 2018, prices went up 18%. So, if you'd owned a 10 million property the year before, you made 1.8 million just by sitting on it for a year. So what everyone immediately says about Monaco is, oh, the prices are crazy. Well, compared to what? We've already talked about how Hammersmith and Fulham went up more than Whitley Bay in the last 12 months. And yet you could get 10 or 20 Whitley Bay properties for the price of a Hammersmith and Fulham one. So, is it that stupid? Are these people, some of the wealthiest people in the world with the best advisory teams in the world, are they all stupid to go and buy in Monaco? Or is it just possible that they know something that you don't? This is the point. This is why you got to keep an open mind on this stuff. There's obviously reasons for this. So one of the reasons that makes Monaco attractive is that you can get international high net worth tailored mortgages at very attractive rates. So these tend to work differently to high street mortgages, and they generally come from private banks in the likes of Monaco, Switzerland, or Luxembourg. And what happens now is you actually deposit a large amount of cash. I'm talking €500,000 and upwards with the bank. So you put a lot of money into their bank account. Now that sounds counterintuitive because they're no better at paying interest than British banks are. So you think, why would I want to tie up €500,000, €1 million, €2 million in the bank? Well, what then happens is they will lend you the funds, often up to 100%, to purchase the property with. And they'll do it on an interest-only basis at some remarkably low rates. And these tend to run for about 5 years, at which point you can renew them. So one of the secrets of how the ultra wealthy use real estate is that they pay interest-only mortgages. The reason being they want to control the maximum value of property for the minimum amount of cash flow. And usually these mortgages will only actually get paid off if the property is sold at some point in the future. So as an example, these rates are in the 1 to 1.5% range. So if you bought a €10 million property in Monaco on a 1.5% interest-only mortgage, you're paying $12,500 a month, $150,000 a year. So if you look back over the last 10 or 15 years, because of Monaco's very finite supply, but ever-growing global demand, it is the world's favorite tax haven, prices have tended to go up 8 or 9 or 10% every year. So you're going to be seeing a gain between, let's say, 800,000 and €1 million a year on something that's costing you 150,000 a year. What's not to like about that? How much of that deal would you like? If you give me 150, I'll give you 800 or 1,000,000. How much of that deal would you like? Now do you see why maybe these people aren't quite as stupid as you first thought? Oh, and by the way, you're going to live in a lovely place with 300 days of sunshine, and you can end up paying 0 tax on your worldwide income. Did I mention Monaco and tax in the same sentence? Oh, I wonder if there's something to learn there as well. And just in case you're interested, blatant plug number 2, this is what we do at monacoestate.com. And again, a lot of the properties there are actually off market. So you have to have inside track access to know what's really going on. But just as an example of what you get for your money, now obviously you'll get more in Whitley Bay. I have to accept that. You probably even get more in Kensington or Knightsbridge. But here you can get a 175 square meter, 3-bedroom, 3-bathroom apartment with sea views in the La Condamine, one of the nice areas of Monaco, and it's just under 9 million euros. So that's going to cost you, less than 150,000 a year to live there, and it's probably going to make 800,000 or 900,000 a year increase in value every single year. You get to live there. You get all the tax benefits. What's not to like? That's kind of where I'm coming from with this. So when you look at the detail, suddenly paying 5 or 10 or 20 million for an apartment in this postage stamp size principality can make enormous sense. In and of itself, the asset will be more than self-funding. It will be massively rewarding you at probably roughly a 5-to-1 ratio, and that's assuming that you needed to borrow all the money to buy it. But separately from that, if you're doing this at all, you've obviously got a high income, or you've got a very valuable investment portfolio or a very valuable business. You're going to be generating a lot less tax requirements from your wealth. So you have all of the tax benefits, the climate and lifestyle benefits, and you've got the financial benefits of that. So that's why the ultra wealthy are attracted to places like Monaco. Now, I can't talk about wealth without talking about the newest source of all wealth, which is cryptos. And I think one of the things we're going to see in the coming decade is an awful lot of wealth that's being generated in the crypto space, moving into other asset classes, perhaps things that are less volatile, perhaps things that are viewed as better stores of value long term. So all of the money that's being created, and think about the billions and billions we're talking about here. If you bought Bitcoin a few years ago for $3,000 or $4,000, and it's now at 65, 66,000 as we record this, you've got an awful lot of profit, an awful lot of equity sat there. What are you going to do with it? One of the things people are having to take very seriously now is the tax implications of the wealth they've made from crypto. That's why some people are relocating to different countries before crystallizing those gains. That's why I think Monaco will become very attractive to those kind of people. Already we're seeing it. In fact, I don't know if you can see this, but this is a local newspaper here in Portugal. And the headline is that the first villas have been sold in Portugal using cryptocurrency. It's actually on the Portuguese island of Madeira. And there's a couple of €1 million plus villas just being purchased with the Cardano cryptocurrency. That's the right-hand one of those ones you're looking at the moment. Bitcoin, obviously, and Ethereum tend to be more regarded as the blue chips of the crypto world. But I do think we're going to see an awful lot of real estate linked developments from the crypto world. So, I mentioned the villas that have been bought there, but, probably more obvious would be stable coins like Tether and Circle. These are linked to the dollar. So they're kind of like a crypto dollar. And that probably, I think, would be the optimum way of exchanging value between the digital asset world and the physical asset world, because it's the nearest you've got to a real fiat currency in the crypto world. What this would require is changes in the regulations, changes in the way the notaires, the lawyers would respond, and also obviously in the financial institutions themselves, who are still very much running scared from all things crypto. But also we've got the potential to democratize these markets, because you might be sitting there thinking, there's no way I can afford a 10 million euro apartment in Monaco anytime soon. But what if they could be tokenized? And what if you could put in 10 or 50 or 100,000 euros to own a piece of that, and then get the equivalent gains from that property market by owning part of the apartment in Monaco with a whole bunch of other people who've also bought tokens in it? Suddenly it becomes more liquid, it becomes more affordable. And if anything, that will actually drive up the prices, because it'll be easier for a whole load of new money to access that market. You've still got a finite number of properties in that tiny little territory. This could work in Singapore. It could work in Hong Kong if you don't worry about Chinese security laws and things like that. It could work in any kind of high-end territory with limited supply of property and rising markets. New York, prime London, whatever. So I think we'll see cryptos becoming an important part of how wealth and wealthy people use the real estate market. And if we've got to end up seeing a crypto version of Monopoly played in the metaverse, haven't we? I mean, that's got to be something on Mark Zuckerberg's hit list. Can you imagine some kind of three-dimensional game? And of course, these days, what we'd have is a stadium full of people watching people playing this Monopoly game. So we'll see how long it takes to come up with that one, but that would be quite something. So to try and summarize all of this using my incredible graphic design skills, as you can see, it's been a real, sorry, let me go back here. That's it. What a masterpiece this is. So essentially the rich are using their cash they've got sitting around. If they've got a stock portfolio, they can use that, or shares in their own company. A lot of people, and this has become hugely controversial in America now, a lot of wealthy people have most of their wealth tied up in shares in their own business. If you look at the Bezoses, the Musks, the Gates, their wealth came from those companies. And they're now being accused of tax avoidance or even tax evasion by hanging on to those shares and not crystallizing the capital gain, which is about as bonkers as you can imagine. But in somewhere in the brain of Janet Yellen, this all makes sense. And it's now being discussed as a serious potential strategy in America, which probably means it could come to the rest of the world anytime soon. So you could use your own shares as collateral if you've got an art collection or the aforementioned cryptos, anything like that where you've got assets with value. That can be leveraged through these private banks who then give you an interest-only loan, so you control the maximum amount of real estate value for the minimum monthly payment. And then once you use that and you buy that property, you're going to sit on some significant capital gains. You could choose to rent it out for rental income. Obviously, that made sense. You can also use this kind of investment, and it started at the golden visa level, but it can go up even higher than this, to get additional residencies and to get additional citizenships. Now, you can get residency in Monaco, you can't get citizenship. There are CBI programs from Europe all the way out to the Caribbean, where you can get a second passport for a few $100,000. Some of the islands now are charging more. I think Malta, I'm not sure, Cyprus may have ended their scheme, I think. But people are using a combination of real estate and fees paid in cash to give themselves more options. And of course, one of the biggest options of all is better tax benefits. So that in a nutshell is how the wealthy are using real estate as an asset to both build wealth and protect wealth, and to improve their lifestyle in ways that would, for example, get them living in a nicer place, and also paying less tax and benefiting from a very sound investment. So summarizing the kind of ultra high net worth strategy when it comes to the property market, they use real estate as a way of taking risk off the table. They've made their money in business. Just have a look at the Sunday Times rich list. How many of them say business and property? Yeah, or show business and property, or elite sport and property. They've made money in one field, they've moved it into another field that they regard as more stable and more kind of capable of preserving wealth for the long term and less risky. Their strategy is to own as much as possible, to control as much as possible for the minimum capital outlay. And when I say own, I mean, even then, there can be structures, especially offshore structures, if you're non-dom and things like that. You can have some very efficient structures that own these assets rather than necessarily owning them in your own name. But the point is, you want to control the highest amount of value for the minimum amount of outlay and ultimately the minimum amount of tax paid on any gains or income. Use your other assets as security for the loans, like the shares in your own company, art, etc. Exploit the private banks. They do stuff that your regular high street banks don't, and they compete for clients. So if you're looking for a mortgage, but you happen to be a billionaire as well, some banks will actually give you a mortgage that they're losing money on because they want to attract you as a client and build a relationship with you. So, when you've got the money to start with, these people are falling over themselves to have you as a client. So you will get really good terms. And of course, the more you deposit with them, the more flexible they're going to be on how much they'll lend back to you. So it's really a structure that is only open to those that can put at least 500,000, probably ideally $1 million plus, into a private bank account, and then get all the flexibility and benefits that come from that, including these very low interest only mortgages that enable you to buy and control multi-million euro and multi-million pound properties for a relative pittance in terms of interest payments. And then they also use these properties where they can to buy visas, residency, citizenship, and tax benefits that broaden their global footprint, increase their net worth, and reduce their tax bill. And as I've said many times, what is wealth about if it's not about choices? It's about options. And one of the ways that the wealthy use real estate is to increase their options on what they own, where they can live, the tax they pay, and the tax their children might pay in the future through things like inheritance. All of this comes into the melting pot that decides how the rich use real estate. So I hope you found that useful, and I look forward to meeting you again on the next Renegade Investor Report. Thanks for watching. Bye for now.